Hey everyone, and welcome to today's DeFi Drop, which features Thomas, founder at Arcadia Finance, the intelligent liquidity management protocol on Base, Optimism, and Unichain, enabling anyone from everyday users to professional market makers to earn yield on AMM liquidity positions with built-in leverage, automated rebalancing, and one-click access to sophisticated strategies. Welcome, Thomas. It's awesome to have you on.
Thank you very much. Thank you for inviting me. And I would say a very good one-liner about Arcadia. It's not an easy protocol, so perfectly done.
Great. I'm glad we got it right. Well, look, I want to start with a bit of your backstory,
Yeah,
understand why you founded Arcadia. I'd love to know what problem you were actually trying to solve when you came up with um,
yeah.
Arcadia. And, you know, just to round up the DEX LP space, it's always been complicated, but also, what made you think you could make it accessible? That's a lot of questions all in one,
Yeah,
but,
sure. I'll try to
you
to
can
to
know.
answer
Yeah.
each of them. So my backstory, I was a bit meddling with blockchain back in 2016. It's already a while ago. First, it was more trading, losing money, but then I was also very passionate how it actually worked. So I started reading into it, and yeah, it stuck with me. So from then on, I decided this is a field I want to work in someday. So back then, I just had my job still. And then especially when DeFi came on, so 2020, 2021, I was immediately very engaging with it. So initially more as a power user. Then I spotted some arbitrage opportunities on DEXs, I think as many people did. But I started building some strategies. So in the beginning it was triangular arbitrage. So you see an imbalance in three liquidity pools, and then you can sell token A for B, B for C, and C back for A. And yeah, it worked quite well. So then we were looking into more niche strategies. And I would say we, it's like me and my co-founder. And yeah, we built a lot of different MEV strategies. Like back then, the term MEV didn't even exist. Like we called it arbitrage. It was both with DEXs, but also non-DEXs. So we also did some strategies using keeping track of stable coins. Even we did the first arbitrage strategy with NFTs back when that was still a thing. So we used for that protocols like NFTX, 2-in-1 transaction, buy it on OpenSea, mint your floor NFT for the underlying ERC20 in an NFT Explorer NFT20, and then immediately sell that on a DEX. So that was all very cool, and it really showed to me the advantages of blockchain. Like we could do these arbitrage strategies atomically, so we didn't have any risk that it would fail. Like worst case, we didn't have the outcome we desired, and we could let it completely fail. Also, we were just two amateur guys, just out of university, so we didn't have that much capital to play around with. But in DeFi, since it atomically, you can work with flash loans, so we could do this crazy strategy, sending around millions that we didn't need to have. Since we could flash loan it, execute it, repay it, and then the small profit, because it was often very small margins on very large volumes, that was our profit. So there, I really fell in love with DeFi. Yeah, in my background, I have worked with traditional financial infrastructure as well, more on the technical side. So with legacy systems, and for me, it's a no-brainer that DeFi is better in a lot of cases. I think I mentioned atomicity already a few times. That for me is really the game changer. That you can batch very complex transactions and execute them all at once, and then it's all pass or all fail. Um, and also, yeah, that we could build these things and we didn't have to ask anyone permission. We could use Uniswap, SushiSwap, and our own pools in one transaction, and you can just build it. You don't have to, I don't know, have permission of either of the protocols. So I really saw the good and the opportunities, but on the other hand, we also struggled with the infrastructure, both on chain and off chain. And like it's really there that the idea of Arcadia was born. So both as an like MEV strategies as a DeFi power user, I would say our biggest pain points were that for every strategy, we had to deploy new smart contracts tailored for that specific strategy. But it's also like if you then need a different pool or need to tweak a small thing, we had to redeploy a smart contract. And yeah, for those who were around, like we did this in 2021, this was when like the ETH prices were super high. So every new smart contract meant like at least $100 to $300 to deploy it. Then as a power user, also like if you wanted to mint in a liquidity position, it was 12 transactions. Like you first had to like get the two underlying tokens in the correct amounts. So you had to do two approvals to do swaps to get the underlying tokens in the right balance. Then you had to mint the position. So again, two approvals to the like factory, the NFT position manager to approve the tokens, and a transaction to mint it. And if you wanted to use it or stake it, like another approval, another transaction. So it's like the second biggest thing of annoyance to me, like the number of non-atomic steps in a thing that like is supposed to be atomic. So either you had to do all of transactions, either you had to have a custom smart contract for it. And then as well, like we had like a whole portfolio, and I was quite involved with lending markets back then. And it was also a pain because like you couldn't just borrow against your portfolio. So I think those three annoyances, we realized we were not the only ones who had it. And yeah, smart contracts. So that it's a Turing complete language. So there was no need that it was that annoying. And in our opinion, with something like a smart contract wallet on chain specific for DeFi was a big gap. And in the end, that is what Arcadia is in its most basic form. It is much more general than pure managing liquidity positions. It's really like an on-chain account for DeFi. So you can do a lot of complex transactions, batch them without needing to redeploy your account. So this is kind of like a different virtual machine on top of the EVM to manage all kinds of DeFi positions. So you can batch your approvals, swaps, loans, repayments, minting positions, redeeming positions. And secondly, you can automate stuff. So you can delegate certain activities to other smart contracts that within these set boundaries let you modify positions, mint positions, but all like with permissioned approvals to that separate smart contract. So a smart contract that can rebalance positions, it can only rebalance positions within user-defined constraints. And then lastly, you can borrow against positions depending on the underlying tokens. So I would say that the idea of Arcadia was really to solve our own problems back from 2020, 2021. It's a smoother way to manage complex DeFi strategies, both to build them as to borrow against them. Yeah, and I think that answered most of your questions. Not sure if I missed one.
You've nailed it.
One last thing I have to add, like I said, the original idea of Arcadia was more the account, so the infrastructure, than the liquidity management. It's more since we, with our MEV back then, were working a lot with liquidity positions, that we identified it initially as the, let's say, market where the problem was biggest. So we started focusing there. But then we realized that the problem is so big that we still only focus on liquidity management. So Arcadia, the real underlying protocol, can do much more than pure managing liquidity positions. But all our tooling, all the periphery contracts now, they are all focused on liquidity provisions, since in our opinion, it's still the biggest market to tackle, where the friction is highest.
I mean,
yeah.
That atomicity point is the real tell. You weren't just trading; you were running strategies that would have been impossible to execute in traditional
Yes.
finance because the
Yeah.
settlement latency alone would have killed the edge, right?
Yeah,
So what you
we used flash loans. Like it's
yeah.
a concept that's impossible if there are non-atomic transactions in between. Yeah, exactly.
So what you've built is essentially the infrastructure you needed back then, but they didn't have it,
Exactly.
and the fact that it grew out of that frustration, it's probably why the pain points feel so precisely targeted right now. But at the core of Arcadia is the DeFi account, right? It's a small
Yes.
portfolio that values assets collectively rather than individually, and enabling complex strategies in a single transaction, as you've said. But can you walk us through how that works in practice, and what does it actually mean for a user
Yeah,
to
yeah.
open a margin account and leverage an LP position versus just providing liquidity that
Yeah,
in the
sure.
traditional world?
Yeah, yeah. So we have two types of accounts. We have margin accounts and spot accounts. Can maybe start with the spot accounts. So with spot accounts, we really don't care what the underlying asset is, as long as this is an ERC20 721 or 1155, or if there's a future standard, we might expand it. But like the core is, as long as it follows the standard, you can use it in a spot account. With a spot account, would say the power of an Arcadia account is what we call our flash actions. It basically allows you to batch a number of transactions. Some are checked on the account itself. So it's like withdrawals, deposits, or transfers. And then there is a free call data you can provide that is then executed by a second layer that has zero assets on it in between transactions and is never used for authentication. So the flow is you would first withdraw assets from your account and transfer things from your wallet to a separate trampoline contract that never holds assets and like has zero security dependencies. And then from the account, you would pass the different steps you need to do that are like non-trusted. So it's like swaps on dexes, minting positions, and you ask the other contract to execute them. The other contract has then some logic to identify which action the user wants and how to execute it. It also has a plain call too, so you can execute any call data to any contract. And as such, like you can, in your backend, construct a series of steps that have to be executed. You don't need to know a smart contract wallet for it. So your spot account can handle all these things. And then everything is executed at once. So in one transaction, you can use assets from your wallet, from your account. Then you can do any transaction you want via the trampoline. So it's not your account that executes it with a separate contract. And then finally, you can decide to either deposit it back into the account or send it to a wallet or anywhere else. Yeah. So yeah, a user like can with his existing account in one transaction do almost anything they want at once.
Yeah. So the trampoline contract and the collective valuation are clear, but walk me through the moment a position goes wrong, for example. So if a leveraged LP position moves against me, what actually triggers the unwind? Who executes it, and how does the cross collateralization
Yeah.
determine what gets liquidated first?
Yeah, so for that, we have to switch to our margin accounts. Margin accounts, they can also work with any standard, but it is working with whitelisted assets. So here you cannot just use any ERC20, like we whitelist which assets are allowed. And for that, we have a risk framework that determines like the initial margin, the maintenance margin, and like a cap per asset. And then any DeFi position composed of those assets can be used. For instance, we whitelist wrapped ETH and USDC. So then you can use pure USDC or pure WET in your account, but also liquidity positions of USDC and WET. Then the protocol will value all assets in the account. And at the end of every flash action, we do a health check. And if the health check doesn't pass, the complete transaction is reverted. And so the steps here are similar as with the spot accounts. There are actually two extra things you can do. So you can withdraw from your account and your wallet, but you can also borrow from a lending pool. Then with those three sources of assets, again, we can do our non-trusted, any type of transaction you want. And then finally, you can either repay or deposit in your account. And then only at the end is a health check done. If anything in the transaction would result in an unhealthy state or a bad state for the protocol, then like the complete transaction is reverted and it is as if nothing even happened. So you can never, as a user, force your account in an unhealthy state. So that's one, say, layer of protection. Secondly, of course, markets after a position is built can turn against you. So therefore, we have a like liquidation framework. So any user can trigger accounts that are in an unhealthy state. Means that your maintenance margin is too low, so the total asset value is getting too close to your total debt, and then you can trigger liquidation. It's a two-step process. So once you trigger liquidation, a Dutch auction starts, and then anyone can buy up the distressed assets, and either you can fully liquidate it or you can buy up until the account is back healthy. So here to unwind the position, we rely on MEV bots. So they calculate the value they can liquidate and decompose all the assets compared to the auction price. And as soon as the first MEV bot thinks they're profitable, they can trigger the auction. So they buy up the auction. I think something neat we do here is that we also use atomicity. So basically, in most auctions, you first have to pay and then you get the good. Like in DeFi, it's actually not necessary. We first give the assets to the guy auctioning, and only then they have to repay. Like the advantage is that, yeah, most arbitrage pods, they don't want to hold the liquidity positions. Like what they do is they buy up the full auction. Then in one transaction, they decompose all assets. They sell it for the asset they have to repay the debt in. And only after they got it, liquidate it, they repay the debt and pocket some profit.
Sorry, I cut you off just as you were about to answer what I had asked. You were just about to start. So that was the margin side. Thank you. So that liquidation mechanics is essentially on-chain prime brokerage, right? The collective valuation is what makes the margin call precise rather than blunt. Which actually brings us neatly into my next question, of which you're actually protecting against, because the thing that keeps most people away from active LP in the first place isn't liquidation risk, it's impermanent loss. Arcadia has two approaches to that. True delta neutral for stable pools and pseudo delta neutral for volatile pairs. Can you explain how those work in practice and how much of the LP or how much of the IL problem they actually solve?
Okay. So the real delta actually here the problem is a bit like with how terminology in DeFi and in crypto in general often deviates from what traditional finance uses. So both of them are actually delta neutral. The difference is that one of the two is not gamma neutral. But yeah, like you have the Greeks in options in traditional finance, like in crypto, people often interpret them differently. So that's why we call them pseudo delta neutral, because it's in reality real delta neutral, but crypto users don't understand it as delta neutral. So the difference is with the real delta neutral, you would provide your liquidity position in two pegged tokens. For instance, in ETH, you can have wrapped ETH with a staking derivative, like for instance, from Lido staked ETH, and then you borrow it. So you're basically looping. Your yield sources are then the trading fees in the wrapped ETH, wrapped staked ETH pool, and you borrow wrapped ETH. So there is no real exposure to the US dollar in any of those assets. If the ETH value would rise, then both your collateral and your debt rises in almost equal terms. So this is both delta neutral, but also gamma neutral. So it doesn't matter if the price moves 10%, then the whole position is still delta neutral. With the what we call pseudo delta neutral positions, it's a bit different. There you would LP in a wrapped ETH USDC pool, for instance, but you would borrow the wrapped ETH. So you would start with 1 unit of USDC that you have yourself in your wallet. You would borrow 1 unit of wrapped ETH from our lending pool, and then you would build a liquidity position that has 1 unit of USDC, 1 unit of wrapped ETH, and 1 unit of wrapped ETH debt. So at this price point, you are delta neutral. You have no exposure to wrapped ETH to the ETH price in this example, but it is not gamma neutral, meaning if price moves, your position is no longer exactly 50-50. So you become less and less delta neutral with moving price. And yeah, most people don't understand it as delta neutral, but like delta neutral in traditional finance is seen as something at this current price, and you have to actively rebalance positions to remain delta neutral. Since in this example, your gamma is not neutral, in the first it was.
So how does it decide when to pull the trigger on a rebalance? And is this part of the yeah. Okay, let me get that right. So first part, how does it decide when to pull the trigger on the rebalance, and who pays for it? Because rebalancing isn't free, and the cost lands on the LP. That's a direct
Yeah,
drag on the yield, and that's
yeah.
what you're advertising.
Yeah, so in the end, it's the user who pays. Like, it doesn't really matter how you frame it or how complex you make it. Like, yeah, we will not front the cost. So we will only trigger rebalances if either the user directly pays for it or if in the fee we take for this service, yeah, that we're more than enough compensated, yeah, for fronting gas costs, for instance. How it works, like this is, I would say, our proprietary models that decide when the best moment is to trigger. So here as well, we have different formulas. So the rebalancer contract, it is a immutable smart contract that has logic how to rebalance a position for an Arcadia account. And so where I said before that the flash actions, that you can provide any logic, here it's actually the rebalancer contract that has fixed logic it will execute in the flash action of the account. So while for the account, any logic can be executed, your rebalancer says exactly what will happen and how. And it also has some checks, for instance, that a minimum amount of new liquidity is minted. So if a rebalance would really do bad stuff and try to steal tokens or have a lot of slippage in some inventory management, then the transaction again would revert. And it also decides when it can be triggered. And this is actually also via a hook that the user can set. So there are some minimum requirements that are always asserted by the rebalancer contract, that it happens the right way and that there's not too much slippage and that enough liquidity is minted after the rebalance. And then there can be some additional user-defined limitations. For instance, that it can only be triggered when it's a certain amount % out of range, that you can trigger it only after a cooldown period, or you can make even volatility or oracle-driven triggers. So I would say the user has the full power to limit when to trigger, and then the backend logic will, within those limits, decide the best moment to rebalance the whole position. So it's quite complex under the hood, but for a user, they select a strategy. They can put additional constraints. Minimal constraints are enforced, but they can enforce additional constraints. And then within those constraints, an initiator, so its backend logic, will trigger the smart contract to rebalance the position. And that contract can only do that. It can only take a liquidity position, like modify the amount 0 and amount 1 of the underlying tokens and mint the position again. And it's the owner of the smart account that can set those permissions for rebalancer contracts and initiators, and only the owner. So let's say we, the Arcadia team, we can only rebalance positions where the user gave the exact mandate to let us rebalance, and even like the rebalance strategy behind it. So it is, in our opinion, like as decentralized, non-trustable as we can get.
So the rebalance has rules, bounded permissions, and third-party initiators doing the triggering, and that's a clean separation of concerns. So let's bring in the chains now,
Yeah.
because where you deploy shapes how all of this actually performs in practice. You guys are live on Base, Optimism, and Unichain now, which is so cool. and which are already handling something like 75%, I think, of all Uniswap V4 volume, but
Yeah.
which is remarkable for a concentration for a chain that's actually fairly new. But what does being on Unichain actually unlock for Arcadia, and how does your stack sit on top of V4's hook architecture?
Yeah.
Are you
I
building
think
with hooks, for example, with specific hooks, or is the
so.
relationship more about like co-location on the same liquidity layer?
We don't build hooks ourselves, but Arcadia can manage also liquidity positions with hooks as long as the hooks are not too exotic. So like in hooks, you can say which additional hooks are enabled. It's not one hook, but it can be before, after swaps, before, after liquidity provision. So if it is not too exotic what those hooks can do, then we can manage those liquidity positions just as we can do for a V3 liquidity position. So I would say we're DEX agnostic and we try to be as hook agnostic as possible. And I think before Uniswap V4 launched, that we really liked the idea. I really thought it would be like as a big of a change of from V3 to V4. I would say in practice it didn't materialize fully, either yet or not at all. But like that's of course things you cannot know up front. So I would say in that respect, our launch on Unichain was mostly related to, let's say, our beliefs what Uniswap V4 would do to market share and how big Unichain would play a role there. So far, that did not materialize. Not sure if it's still too soon. If some new hooks will come that are a real game changer, or yeah, that the market decided that it's not good enough. I don't know yet. But we didn't write it off yet. So I think still there can be some killer hooks or some killer things on Uniswap V4 that will drive a lot more demand to those pools to be used.
Okay, I mean, I guess you're at a good place now. You don't need to push the boundary too far. You can.
No.
It's a sensible line to draw right now, I suppose. But what about incentives? So you have an incentive layer on top of all of this. You've launched the AAA governance token with a vote escrow model.
Yeah. So
STAAA. So yeah, for voting on emissions and Arcadia improvement proposals. But how does the tokenomics model work, and what does the staking unlock beyond governance? And how do you think about aligning long term?
yeah.
You can expand on all this. Yeah.
Yeah, sure. I think like we said, Arcadia has quite some possibilities on those rebalance strategies. And that can be very simple if out of range rebalance to a 50-50% position. But those strategies might work for some pools, but they're too naive in most cases. So in most cases, you want much more elaborate strategies, sometimes even with multiple liquidity positions at the same time. And that has a cost for us, like both backend as on-chain. And the Arcadia token is one way to enable those strategies. So like if you just want to try out the protocol, you can with simple strategies and no upfront costs. If you want to dive more into, let's say, the real power strategies, for that, like you have to be aligned with the protocol. And so there, Arcadia tokens are one unlock. Secondly, with the staked assets, the staked Arcadia tokens, there is a possibility to like send protocol revenue towards staked holders. So that's already baked into the contract that like the emissions you can get from staking is both new AAA, but it can also be sources of revenue or other emissions or incentive layers. So I would say in the end, it's really if you believe in the Arcadia protocol and that we can grow and gain market share, like it's both to get as a power user invested in the protocol or as a long-term believer, like to see if the protocol has grown substantially and there is excess revenue, then part of it might go to token holders.
Yeah. Okay. Nice. You also have the flexibility there. Yeah, it's an interesting model. I mean, you didn't go the full curve route, so No mandatory time locks or bribe markets and stuff. So
No,
yeah.
I think in the later like topic we might go there. I would say like we're still fully in the building phase, and that's both for the protocol as everything around the token. So I would say with the current smart contracts, the AAA token is as simple as possible. Like it's a pure ERC20 without any fancy things. The staked AA token is quite opinionated with our current contract that already can distribute emissions. But the whole idea was to separate it from the start that if we want to, let's say, give a bigger role or go to some, let's say, more things like VE models, like your aerodrome, we still can, and it wouldn't require a token migration. It would be, let's say, the stake AA that could replace with a different, let's say, on-chain emissions model, but it has zero impact in the AA token itself. So
Okay.
that's why we have separated both from the start. It gave a little bit more friction because, yeah, you have to explain what the difference is between the both, and like, yeah, I get for users that it are not simple things, so you have to learn a bit why too from the start. But this gives us the room, like to go to, let's say, more fully on-chain models if the protocol is ready for that.
Yeah. There are a few in the graveyard of the on-chain option space right now, right? Open and Ribbon,
Yes,
Edgec,
yes.
Lyra. So they all took a run at it, and liquidity stayed thin and fragmented. But so roadmap wise, I know you've just been chatting a little bit now about, you've hinted a few things coming down the line, but what your 2025 roadmap mentioned several things that are particularly interesting. The yield stabilizer to address the unpredictability of DEX LP yields, on-chain options for LP hedging, institutional white labeling. Where do each of those stand, and which do you think is the most important unlock for mainstream adoption now?
Yeah. I think the third one, so the white labeled for institutions, I think there we did fairly well. So beginning this year, we announced Arcadia Foundry. It's basically the same underlying technology, but like the product is a bit different. It's really tailored on currently protocols. So it's for protocol owned liquidity or treasury management, or L1s that want to deepen their liquidity on their chain. And it uses the Arcadia smart contracts, the Arcadia data behind it. But the rebalance strategies, for instance, are a bit different. And for retail users, they're really focused on different objectives. I think where a retail user is more focused on yield within their risk tolerance. Protocols often have different objectives. Yeah, of course, they want yield if they want to get yield. But when they bring their own token in the market, they mostly want to provide liquidity around any price, and they want to preserve their capital. So yield is like a tertiary objective. So for that, we have very bespoke strategies, really focused on these type of players. So I would say there we did quite well. So since January, we are working with a couple of protocols with this, like Animoca, Brands, Summer Finance, and a few others. Then the second one, the options. I think you mentioned already that the on-chain options so far didn't materialize. I think there are now some new kits on the block that seem to do it better.
Of course.
But for our use case, unfortunately, like we did our research and the premiums would be too high, so they would eat away all yield. Like we have been looking at different solutions as options. So what we want to do here is hedge impermanent loss. As an LP, you're short gamma. With options, you can build strategies that you're long gamma. There are other ways to hedge it. You cannot fully hedge it since LP positions are notoriously non-linear. So best you can do is like approximate a hedged payoff curve. So yeah, with borrow against your position, it's a very simple way to do it. But yeah, as I said before, it's not fully gamma neutral. With perps, you can also play. So I would say this is unfortunately not yet built for retail. It's not yet in the depth that you
Okay.
can out of the box hedge your position with options, with assets, and with debt. We did some proof of concepts though, and I would say maybe for the big power users, we can help them set it up, but it would be they would have to do it separately then. So they have to manage
Mm.
their Arcadia accounts separately from an options protocol or even off-chain options. Since on-chain the markets are not yet where we need to be them, like to make this work atomically within one portfolio, within one account. And then on the first one, the yield stabilizer, like that's still on the roadmap.
Okay.
So I think we also will touch it later, but we had some big incidents in 2025. So unfortunately, we had to move back certain parts of the roadmap. Like more positive, we also get some new IDs and some new inbound demands that we think have priority over other things on the 2025 roadmap that are now in the 2026 roadmap.
Mm.
I think the biggest one here is for Aerodrome V3, like their MetaTex 03. Like we didn't know that was coming when we like built the roadmap, but I think their solutions like Arcadia can play a much bigger role. Like with Aerodrome V3, their on-chain liquidity management will look similar. So our current setup works there perfectly, but they will also have predictive markets. So not prediction markets, but predictive markets for their emissions. And there as well, like it will be more efficient for users. So they will be able to earn more by predicting which pools to select to give their votes to, but it will also get more difficult. So I think we have the perfect placement to like play a role here. We
Mm-hmm.
know quite well how our drone works inside. We have quite some data backing it. So there we want to build as well an autopilot, not only for liquidity management, but also for your voting management of your arrow emissions. So I think that one moved. And then lastly, vaults have been the hot item of the past year. I think the idea of vaults is that you even make strategies more simple for users. They have to give up some amount of custody over their assets. I think most default strategies, a curator has quite some power over your assets.
Mm.
But the advantage is that the curator literally makes any decision. Like a user, the only decision they have to make is how much they put in and how risky they assess it. Uh, and what we want to build is like a vault layer on top of an Arcadia account. It's then basically a curator that manages the strategy. So they decide the pools to go in, the rebalance strategies, the ranges. Still benefits from everything Arcadia offers. So you can still build hedge positions with depth, or you can do automations to compound yield, to sell yield to certain assets to rebalance. But those decisions, which pools, which automations, like also you have to make decisions as how broad you want. Like we have some volatility-based triggers. Those will all be made by a curator, and a user just has to decide, do I want to get in it or not, and how much USDC or
Mm.
web app would put in. So I would say is also a big thing we're working on.
Well, there's a lot of moving parts in your roadmap, which is great, by the way. It sounds like the options piece is still some way from being a one-click solution inside a single portfolio. But let me just touch on one thing you mentioned, which, unfortunately you had an incident in 2025. Can you believe we've got almost to the end of a DeFi podcast without talking about incidents?
Yeah.
You know, so yeah, no, it would be interesting to chat on your take on what's going on right now, and your learnings as well from
Yeah, yeah.
before. And we've just, for anyone tuning in right now, just to understand when this was recorded, I think 3 weeks ago had Kelp DAO, maybe 2 or 3 weeks ago the Kelp DAO exploit. So it's been a hell of a ride in 2026. But yeah, I'd love
Yeah.
to hear your thoughts on everything. And
Yeah, I can maybe
yeah.
start like with what happened with us and then go more into the
Mm.
like industry wide. Let's say we had a security incident in one of our periphery contracts, so one of our automation contracts. So like, nothing in the Arcadia core, but unfortunately it was quite a popular automation. So there was, I think, a bit over 3 million lost. Um, yeah, my learnings. So I think we did everything according to the standard book. So it was audited. We had on-chain circuit breakers. We had active monitoring. Let's say problem is like in DeFi, we're all about transparency. So yeah, the attacker could on-chain see how our circuit breakers and our monitoring look like. And yeah, it was kind of a double attack over multiple days where they first did like a decoy transaction that did not work, but already triggered our circuit breaker. Then we have cooldown periods for those circuit breakers, and then within the cooldown period, they did their actual exploit. So then we couldn't re-trigger it. I think what we learned here is, yeah, that you often build multiple layers of defense, but some layers can impact others. Um, and yeah, that adding more things not necessarily makes your solution safer, but in some cases, like, yeah, less safe. So we had this cooldown period so that we could never lock up user funds, or if our multisig would get like changed of owner or down the road, like the whole team would stop. Like we could never lock user funds, and for that we need cooldown periods between circuit breakers. But yeah, that's then a weakness you introduce to solve one problem and you create another. So I think what we really learned is that like one, you can never be sure there is no bug in your protocol. So you should assume that in every smart contract there can be a bug. And then the outcome of that is that the impact of that bug should never result in a total wipeout of all assets in that contract. So you need multiple layers of security, but it has to be holistic, so that one bug cannot result in the full wipeout of your protocol in total. I think that ties in very neatly in what happened with Kelp. And also like all your layers of your security, like, yes, as I said, should be one holistic whole. So for instance, we redid our circuit breakers, we added additional layers, and here we make it that actions that increase risk can be passed always without cooldowns. Only actions where risk would be reduced, like we still have those those cooldown periods in between. So now it's I think a very clean trade-off where we can still never lock up user funds, but we can always pause taking debt, depositing actions, or enabling automations. And secondly, like we no impact on one area of the protocol. Like there are of course unknown unknowns, but as far as we know, can impact the full balance of the whole protocol. So if there's somewhere an issue, like there's only a percentage that would be able to be stolen, and then we count on our on-chain circuit breakers to kick in. So it's not our previous assumption where we say the whole protocol should be foolproof, and we do everything to make it foolproof, and then it's fine because we believe there are no bugs. Like now we still do this, like we still try to make it foolproof with no bugs, but we try in our whole architecture to build in like a lot of different things that have to be together wrong in order to exploit. If just one area has an issue, either a fraction on that one contract can be stolen, either it can be stopped after it, either even before. So for instance, all our accounts, all the assets are separated, so there's no giant pool. Secondly, like we have a cross account reentrancy guard, for instance. So there are a lot of things that we isolate and separate. If there is an issue in one of them, like everything can be passed. So yeah, it's a very tough learning. It were very hard weeks, months. Like I still don't think like that we were like how to say it? Like I don't think we did anything upfront knowing what we knew then.
Course.
Yeah, so very, very annoying situation. Like I would say the protocol still has some not fully recovered from it, of course. It's all about reputation. So we're still every day trying to rebuild and to regain confidence. We were able to restart the protocol. I think a lot of the impacted users were very cooperative and supportive. So that's definitely really also the good side in these bad moments. Like that you also see that like people realize that like even though we do our best, like yeah, we're still human. So we clearly state that we do now everything in our power to never let this happen again. So we
Yeah.
are very transparent in what happened, the way forward. I think we already did 3 of the 4 items on the way forward, with the fourth already like in our head how we will do that. So yeah, we did everything in our power before, even more after, and now it's all about regaining trust and yeah, some painful learnings that we carry with us. But in the end, that's what makes DeFi as a whole safer over time. I think it's hard to believe for some people now, but I truly believe that.
Yeah. Yeah. And you're right. It should be making it safer. You know, right now there's never been a better time for everyone to get together
Yeah,
and really look a bit
yeah,
further
yeah,
into their security checks and protocols.
and I think that that ties very well with the AV Kelp Layer 0 situation. I
Mm,
think here, like to start with, it was not a smart contract breach. Like it's an RPC provider of a bad setup. So I think more and more of the hacks we saw last months were less smart contract, more actually decentralized dependencies that still exist. So I would say being more decentralized would help more. Secondly, I think circuit breakers have this connotation of a central party deciding when to kick in with the connotation of censorship, but I don't think that necessarily is what circuit breakers need to be. I think there are
mm,
some very good implementations in protocols where there are already like some things that slow down how much can be withdrawn or like minted atomically. Um, for instance, that only percentage of total market cap can be added per X minutes. And these type of things are 100% smart contract enforced. So it's a circuit breaker in some kind, but it's not a central party that decides. I think these kind of things would have helped a lot in the thing we saw with Kelp DAO. Like in the end, the amount of assets that were minted on ETH mainnet were a very substantial amount of the total market cap, and even more than there was on Unichain. So with some sanity checks, that would cost a bit more gas. I agree, and it would be maybe annoying for guys like Justin Sun who juggle around with billions. Like for the average user, it would never be annoying, and I think that Justin as well would understand that he has to do batches of 25 million every minute instead of the risk of losing 100% in a second. And those conversations are ongoing now. So yeah, I think it will be very hard to hear from non-tech people, but like yeah, we are learning and we are improving. Um, so I think we are. And
yeah.
then let's say the last point on this is like with AI, I think some of the new exploits we see can be tied to new AI models. And there I am actually optimistic, since like we have this concept of Lindy, like the longer something is in production, the more sure you are there are no bugs. Uh, the problem is so far it were always humans looking for bugs. Now it's AI looking for bugs. So we kind of reset it for everything that is built up till today. So we lost the Lindy effect of things that are safe now. Yeah, it can be some very boring old library that no human has saw for the past 20 years that now AI is looking into. But I think it will get much stronger over time post AI, since like yeah, everything that's old that survives this time, so these few years, yeah, that is not only checked by all of humans, but by a lot of malicious AI tools and white hat AI tools, and is safe. And I think AI will reread much more of the boring libraries than humans ever do. So I think going forward, the effect that things that are not exploited post this very tough era, like, will for sure be safer. Like every 5 years that passes, the amount of extra safety you can assume will be much bigger than, let's say, the past 5 years of a legacy code. So it's really sucks now, since it feels everywhere. It's not only in DeFi, but I think it's a painful moment we have to go through to get all the bugs out by
Yeah.
AI, either malicious, non-malicious. But as soon as this like very tumultuous period is over, I think the protocols that are surviving post it, yeah, there we will finally get the let's say safety over time, which we always count on with DeFi, that it will truly materialize.
Yeah. Well, no, I firstly thank you very much for being so honest and open about your experiences, as well as touching on the broader landscape now. I agree with you. It's very interesting what's going to happen with AI. We've just started to see that this year on the security side. Really, well, not just this year, but we've seen a big impact this year, let's say. So yeah, it'll be interesting to see where we go. I won't be too long because I need to wrap up soon, but I want a couple more things here, but look, you're building for LPs, right? I just want to ask quickly, how do you believe, or do you believe there's a path to bringing someone with a Coinbase account, Coinbase Prime, a passive yield mindset person from an institutional platform like this, or let's say a
Yeah,
simplistic users platform and an experience like this, into an active LP management mindset?
no, I don't think so.
It's not going to happen.
No, it's not gonna happen. I think it was our original thesis.
Mm-hmm.
So if we make it simple enough, that anyone can set it up. But the thing is, with an active strategy, like, since it's active, you can automate everything, but you still have to let the user make decisions. Like, yeah, it's very configurable. Like, within an automation strategy, there's still thousands of parameters, like how broad, volatility-based triggers. Like, you don't necessarily have to, for instance, to rebalance, to sell and move. You can also increase ranges, decrease ranges. You can work with multiple LP positions. Um, I don't think like a user that's not interested in this wants to figure this out. Like, they just want to know, is this a healthy source of yield? If yes, what is the expected yield? What are the risks? And if this suits me, they're willing to passively provide liquidity. And that's exactly also why we will build a vault layer on top of it. I think our initial assumption was that it is possible. I think we have built all tooling. There is still a big market for it. Like, current DeFi power users are not institutions who like to do it. But I think most people who were in DeFi, I would say up till now, are partly in it for the yields, partly because they truly like love it and like to play with it and like to understand it. And I think for those users in the past, like, yeah, you can as well do market making on a traditional exchange, but there it's important you do big volumes and you have low latency. So in
Yeah.
practice, let's say a guy interested in market making on centralized exchanges will never be able to really do it. I think on DEXs it's different. There are definitely still some like like edge that a professional guy has, like for instance for 6DEX arbitrage, or like separating toxic flow from non-toxic flow. But there is, like, that's it. All the other things, the interested DeFi power user has almost the same tooling as the institutions. And like, yeah, they already do use Arcadia and they like to use it. So those are, I think, are served with
Yeah.
active liquidity management or market making in DeFi, which they cannot do in CeFi. For the average user, I think that will never happen. That doesn't mean that part of the yield they earn comes from fees on DEXs, but it will be indirect, either through a curator, either through like lending pools that borrow money that lend money to people that borrow it to LP.
Well, I think you've hit it on the head there. Active LPing may always be a power user at its core, right? And perhaps that's fine. Not every product needs to be a Robinhood, right? So, Thomas, it's coming to the end, but I really need to thank you so much. That was a really insightful, great podcast edition. I'm so pleased we did this. I've had you guys on the radar for a long time.
Thank
And
you.
once again, thanks for being so open and honest about the DeFi situation in general. And I think we are going to improve for sure. I do have one question, which is the question which every guest receives at the end. We spoke about this before we hit the record button. What's your prediction for the total DeFi TVL as per DeFi Llama for the 21st of June, 2026? Today, it's currently $84 billion. Where are we going? Are you bullish or bearish?
I think in a good month, I'm bearish. So I would say 80 billion.
Okay. Down
Reason
4.
being, like, yeah, the Alpha Kelp DAO situation is still not resolved. And I think there are still some people with funds locked up that they would like to withdraw.
Like
So
me.
yeah, yeah, for instance, yes. So unfortunately, I don't think in the near future we will grow. I think we will drop a bit because I assume the situation will be resolved by then, and then all of people that already want to withdraw but can't will. But from there, it's up only.
Good man. And also, you win a special prize because you're the first guest who's ever predicted a more bearish outcome than
Okay,
today's total TVL. There you go.
nice. Yeah, not sure that's a good thing, but yeah, it's how it is today, unfortunately.
Yeah, it's good to have the honest approach. Well, thank you very much, Thomas. Let's stay in touch, and anything we can do for you guys or continue doing with portals, let us know. It's great to have you guys on our platform as well.
Thank you very much. It
All
was a
right.
pleasure.
Cool. Thank you very much. Chat soon.
Bye.